And Lemonade truly has AI like deep in their DNA as a company. They're trying to unleash it on every aspect of their business.
Solving insurance in the age of artificial intelligence using pure software, re-underwriting it from first principles is a big, hard, hairy problem. Lemonade feels a lot today like Tesla felt like when I first invested in them.
So that means that they're taking more of the risk, but also reaping more of the rewards. But they're about to hit this inflection point where they're literally doing $5 in earnings per share per quarter.
Their ability to gobble up market share and just, dramatically grow profitability is insane. Did you save me money? Okay, sweet. I'm in.
And if that's true, that's almost all you need to know. That's going to be the most important thing in the insurance market is like pricing competitively and keeping your customers happy, and doing so at good margins. To me, like Lemonade passes that test with flying colors. I think companies in 2035 are going to look a lot different from companies in 2025. And to me, Lemonade is a very good prototype of what I think is more likely than not that companies would look like.
So today we're going to be taking a little bit of a right turn and talking about a company that I've never actually talked about on my channel, and that is Lemonade. And for this episode, we have Matt Smith with us. He is part of the Rebellionaire team, and apart from being huge Tesla bulls and having great bets and great calls and helping a lot of people manage their Tesla investments, they also have a very large position in Lemonade relative to the overall float. So they've done some really cool modeling. And today we're going to dig into, Matt, what is it that you believe the fair value of Lemonade is today as we sit somewhere in the neighborhood of a $70 share price?
Yeah. So first of all, thanks for having me on, Hans. Excited to talk about this. It is funny because we're Tesla bulls. I think people know you and I mostly for our Tesla content. So whenever we do anything, at least it's been my experience outside the Tesla world, there just seems to be a little bit less interest in it. But even though I find this company and this topic like super interesting. So yeah, bit of a right turn, like you said. But I'm happy to kind of share why I think this company is still so misunderstood and undervalued. Not financial advice. I'm a financial advisor, so I've got to be very careful about not giving any investment advice. But I'm happy to kind of share my thoughts on where I think the share price is today, or should be today, just based on a present value analysis. And we'll kind of go into all the logic in the model. It's pretty beefy model. There's a lot of different components to it. So I'll try to kind of walk through what the main assumptions are, and then how that translates to, results in later years and what that implies for the fair value of the company on a present value basis compared to where the stock is right now.
Yeah, and I don't really want to bury the lead too much. And so I would say, the one of the things to call out is one of the reasons we love Lemonade that is tie over to Tesla is operating leverage. And it seems like Lemonade is continuing to just build an incredible amount of operating leverage. And they just haven't reached that inflection point yet that Tesla reached finally with the Model 3 production ramp. And so we're kind of getting into that phase. And I think Lemonade feels a lot today like Tesla felt like when I first invested in them in 2018, 2019 timeframes. And so, building positions here feels really exciting. Obviously, they have, gone on a little bit of a run recently, but still well off of all-time highs. And then, let's give the viewers just the teaser on what do you believe the fair value is, and then we can get into how you arrive at that number.
Yeah. So, to not bury the lead, as you said, the present value I'm coming up with in this version of the model is $192 per share. So that's, not like some future 5-year out target. That's the present value of all the cash flows that I'm calculating today. And then, just dividing that on a per share basis. So yeah, to your point, even though we've gone on a pretty significant run, I mean, we're up, I don't know, roughly, 3 or 4x over the last year or two, depending on which time frame you're looking at. So the stock has gone on an incredible run. But despite that, I think the company is actually over executing relative to certainly my expectations a year ago. They're over delivering, and the story just changes so much. I mean, as you're highlighting the operating leverage, I remember that exact same feeling in 2019, looking at Tesla, just being like, okay, the operating leverage is definitely here, but people weren't really looking at it because they're still posting losses, and there's this cash flow burn concern. So there's a lot of skepticism when you haven't quite done it yet. But for me at least, it wasn't too hard to kind of look around the corner and say, okay, well, Model 3 is going to be ramping. After that, we've got Shanghai ramping. So when you get your revenues to some critical mass, then that operating leverage really starts to deliver results that the market was just not expecting. I vividly remember looking at the 2020 analyst estimates for earnings per share after the Q3 2019 report, when Tesla, to me, just like shattered the bear thesis completely. They posted profitable earnings per share. The cash flow was there. And still, all the analysts were like, well, I think earnings per share is going to be negative next year. And I was like, how? Like that just like the volumes are only going to go up from here. Revenue is only going to go up from here. And with this operating leverage, like, your earnings per share is actually going to be significantly higher. So I feel like a bit as if that's where we are with Lemonade right now, where they haven't reached that critical mass yet, but they're very close. And so what I'm trying to do with this model is to just kind of play the story forward, which we'll get into in a minute about what I mean by that. And just say, okay, well, what does this look like when you do reach that critical mass? And one of the things with AI that we always talk about is like, the AI doesn't just stop getting better. It's going to continue to improve and have more capability. And Lemonade truly has AI like deep in their DNA as a company. They're trying to unleash it on every aspect of their business. And so we're seeing results across every aspect of their business, from like customer service to the loss ratios. Everything is just improving. And so I think there's a lot of things that over time are just going to really bear some pretty tremendous fruit.
Yeah, it's almost like they've been building, the equivalent of full self-driving for insurance for a number of years now. And it is to that point where, it's like, oh, like, this is really starting to prove results. Yes, it hasn't, gotten to the point where it's been able to recoup all of, we're still down before the J curve has reached cash flow break even over time, but it's coming very soon. And yeah, now you can see the trajectory of that upward ramp in cash flows. And it is exciting.
Yeah. I mean, for a lot of years, I think management was saying all the right things, but they, the results weren't really manifesting themselves. Or the AI benefits weren't really showing up in the financial results. And now I think we're at this point where it's very clear that what management's been saying for years is actually happening now. And so it's just a matter of time and scale to get to the point where we're on the other side of this, and profitability looks really impressive. So I'm excited to kind of share my thoughts and how I'm coming up with such a crazy valuation number relative to where the price is right now.
All right, well, let's go ahead and dig into that now.
Sure. So and apologies at the outset. Yeah, I think there's probably no good way to share a model like this. There is a lot of numbers, and really these models, for the most part, I kind of make for me, not to share. So there's a lot that goes into this, but maybe I'll just start with kind of an overview of the income statement, and then we can kind of drill down into how am I coming up with these numbers. So I've got historical figures spread in the past here. I've hid those columns because it can just be a little messy to kind of look at. But essentially every single quarter for the past many years, I've been updating this model with the actual results as they're coming in. And so then I'm kind of comparing their actual results to what I'd modeled. And so that provides some sort of basis of truth, and it's a good means to keep me honest as I'm going forward. So just to start, one of the key metrics for Lemonade is what they call in-force premium. So in other words, how much of the premium that a customer like me is paying out every year does Lemonade have? And so right now they've got just about 1.2 billion in in-force premium. In their investor day last November, they detailed ambitions to scale to 10 billion. They didn't provide a time frame, but you can actually do some sleuthing, and when you do that, with the kind of growth CAGR that they indicated, really it would be by 2033 or so that they'd be 10xing the business. So it implies a pretty drastic growth rate in their in-force premium, but it's one that they've actually been accelerating their revenue growth recently, which is pretty compelling. So, but that all the financial metrics really flow from how quickly this in-force premium line is growing. So then in any given quarter, roughly a quarter of this amount is going to be recognized, just because, this is an annual figure. And so on a quarterly basis. So I've got a bit of a formula I won't go into, because it's not going to be, exactly that. I've got a separate buildup, because there's some kind of time lag of how much premium have you written in the current quarter versus how much is up for renewal from the 4 quarters ago period. So I've got a buildup that kind of goes into that. And then we've got a amount that is ceded to reinsurers, and then Lemonade is actually retaining an increasing portion of their book. So, it was the case up until very recently that they were ceding 55% of their premiums to reinsurers, and they were only self-insuring essentially 45%. Now you've got to pay a bit of a premium, no pun intended, when you do that to the reinsurers, because they've got to recover some costs. But what Lemonade announced recently is that they're actually going to bring this figure down to 20%. So that means that they're taking more of the risk, but also reaping more of the rewards. So this is going to do a couple things. One, it's going to accelerate their revenue growth. But then 2, it's also going to be more profitable growth, because you're not giving it, that kind of commission to the reinsurers.
So just because this is one of those numbers that I hear a lot, and honestly, I've never really figured out exactly, what is the definition of in-force premium? Is in-force premium like the total premium minus the premium that is paid out to reinsurer, or like passed out to reinsurers, or is in-force premium include what is being ceded to the reinsurers?
Yeah.
How does that break down?
It includes what's written or what is underwritten by the reinsurers. So think of it almost as like the gross amount that's being insured by their platform. And then some amount of that they're essentially handing off to the reinsurers and then collecting a commission on that.
Gotcha. Okay.
Yeah. And so I was actually really surprised when they announced that they were going to drop it. And I would say especially so when, it wasn't just a minor drop. It wasn't like we're going from 55% reinsurance to like 40. It was 55 to 20. And on a growing in-force premium, I mean, you can kind of see when they finally get to 20%, which is going to be Q3 of next year, their revenue or their in-force premium is going to be about 50% higher than when they first made the change. So, it's a very significant amount of additional kind of balance sheet that they're putting at risk. And I think the reason that they're doing it is their cash flow has been so extremely strong. And I think their underwriting, which I think a lot of people understandably had a skeptical eye of like, okay, is your AI actually doing anything on the underwriting front? Because their loss ratios were historically like either worse than industry average or occasionally like kind of okay at the industry levels. But last quarter, they had a loss ratio of 68%, or 2 quarters ago, they had a loss ratio of 68%. And this most recent quarter, it was at 62%, which is phenomenal. And what that is essentially for every dollar in premium that you're taking in, how much are you paying out in claims? And so to only be paying out 62 cents on every dollar is just phenomenal. And if the company can keep up that type of level, now I don't expect it to be quite that low into perpetuity. But I think it does 2 important things. One is it justifies their AI approach. And then 2, I think it actually gives you the ability to give them credit for sustained low levels of loss ratio going forward. And then as Shai said recently, they can actually, rather than keep loss ratio so low, they can try to compete on pricing and essentially accelerate growth by competing on price rather than having kind of juicy margins. So this is all in the back of the AI that they've developed in-house that gives them this benefit of pricing so effectively.
Yeah, and that was the thing that really stood out to me about, commentary around this year's earnings was exactly that if they can grow margins to the point that they can actually undercut on price and still, like, if they can make more than their competitors,
mm-hmm.
and sell at a lower price than their competitors, their ability to gobble up market share and just, dramatically grow profitability is insane. And it really just shows finally, the ability of Lemonade to reap the rewards of all of this investment of time and energy that they have put into, developing all of the AI tooling throughout Lemonade to really be able to just leverage and grow, and with, off of a fixed cost base. And that is what's creating the operating leverage that we're talking about.
Yep. Yeah, that's exactly right. And so you can kind of see here in the out years, what's happening to revenue. I mean, granted, this is a forecast, so it will be wrong. The only question is, like, what's the magnitude of how wrong I am,
and the direction.
And the direction. Well, yeah, that's true. But I think regardless of how much I'm off by, the clear trend is going to be that in-force premium is going to be growing. So here, I've got the year-over-year in-force premium growth. So it's like 32%, 43, which is slightly higher than management's long-term guide that they gave at last year's Investor Day. But also, I think it's extremely likely, especially given some of the stuff that's happening on their car product right now, which I think we'll probably get into in a minute here. But then because they're self-insuring so much of this, the revenue growth is actually going to look even more significant. So I've got 39% revenue growth for this current year, then jumping to 71% next year. Now this is that'd be a very impressive number, but I also want to just stress that what really matters is the growth in gross margin dollars. So a big chunk of this is just the accounting of what happens to your premium when you're essentially counting as revenue all the earned premium instead of just a commission income. So even though your revenue is going to be increasing very significantly, I think next year, you're going to have a very significant increase in your cost of goods sold, essentially, because you're owning so much of the risk as well. So very impressive revenue growth, but the thing that's really going to matter is what happens to margins. But good news is that's going to be pretty nice as well. So then we've got the net loss ratio. This is one of the things that was one of the biggest changes for me and for my model. So, I had previous versions of this model that had something like $130 kind of share price. And that was for the most part based on management's long-term guidance of loss ratios in like the 70 to 75% range. I didn't really want to give management, or I didn't really want to, bake into my own model lower levels of losses or of loss ratio when management wasn't essentially giving us that information. But with the most recent 2 quarters being so low, and then management said on the call that barring any surprises, Q4 was actually going to be their lowest level ever. So even better than Q3. So that's why I've got 63% net loss ratio here. So given that, I mean, you're gonna have 3 quarters in a row of loss ratio sub 70%. To me, it seems very logical to assume that they will be in that sort of level in the longer run. So I've got this kind of stabilizing in the mid to high 60s in the longer run. So essentially, I'm not assuming any improvement from where they are right now, which could prove. To me, that seems like a reasonable assumption.
Yeah, just betting on reversion to the mean instead of a continuation of the downward trend.
Yeah. I think, because if you get to levels where the loss ratios are like too low, then you're essentially kind of taking money from your customers. And Lemonade does have this give back thing, where any profits below a certain level for individual customer cohorts, they'll actually give back to charities. So I don't think kind of assuming that this would continue to drop to like the 50s on a long-term basis would be a reasonable assumption. So yeah, this was a pretty big change because the difference between 68 and 73 is a pretty significant difference for the overall profitability of the business. So then from here, going to the expenses, I think this is maybe not as interesting, so I won't spend too much time here. But this gets to the kind of operating leverage. And one thing to keep in mind is you see the growth in this loss and loss adjustment expense. That's just because that's how much you're paying out in claims. But if you look at these other line items, maybe also excluding sales and marketing, because that's really an investment in your growth. So if you look at these other lines kind of down here. These are much more stable, and as the company or as the business is growing 40, 50% a year for many of these years, these line items, actually virtual agents interest probably doesn't count as much, but like technology and development stays relatively flat, and the general and administrative expenses are remaining relatively flat. So that's where this operating leverage that you were talking about earlier really comes in, is you can service a much larger book of business on a technology platform that was built from the beginning to scale to a company that's like 10x the size that it's going to be, or that it is today.
Well, and even virtual agents, like, yes, it is growing. It is a variable, it's a variable cost instead of a fixed cost, but it's a much smaller, overall slope than you would have if you were servicing that with people instead of AIs.
Yeah. And just to orient people on this line a little bit, this is I actually included this in here separately. It's not the way that management reports it. But essentially, there's interest on these loans that they have from a company called General Catalyst. Technically, it's not debt because there's no downside protection for General Catalyst. So in the event like an entire customer cohort defaults, Lemonade doesn't have to actually pay General Catalyst back for that. So it's very, very important that it's not recourse debt. And that's a big part of the reason that Lemonade is able to balance sheet more of these loans themselves, because their balance sheet is actually pristine. They don't have any debt. So they do, they're essentially giving up a sliver of the economics of each cohort that General Catalyst is essentially helping to cover the upfront costs of. So General Catalyst gets a fixed return on that. But there's no downside protection for General Catalyst like there would be for typical debt financing.
Okay. Well, I obviously misunderstood that. I thought that was an expense related to, running Maya. I didn't realize that was actually a part of the financing of the actual.
Yeah, I mean,
policies.
it's really related to that marketing spend. So I think one of the most important assumptions in here is actually how much are you spending on this sales and marketing. So you can see this here, and really what this line is how much are you spending to acquire new customers. One of the ways that I built this model up that I think is different from the way anyone else has built up a Lemonade model is by looking at each customer cohort individually. And this probably deserves a bit of a kind of walkthrough. But one of the things that management always talks about is what is the LTV to CAC, or the lifetime value of a customer over the customer acquisition cost. So in other words, if you spend $100 to acquire me as a customer, and then you have your AI essentially look forward at all of the future years of my cash flows. So I'm paying premium every single year. And then there's some probability that I'm going to have a claim. There's some probability that I'm going to churn away and switch insurance providers. And there's some probability that I will cross sell and say, oh, you know what, I need car insurance now too. So that they have their AI essentially predict for every single group of new customers that they acquire what that future stream of cash flows is going to be. And then they constantly check, okay, how accurate were we? How accurate were we? And they're getting more and more accurate over time. And that allows them to have the confidence to say, all right, let's spend more money on acquiring these customers, because what we're finding, and management says this pretty consistently, is that if they're spending $100 to acquire me as a customer, the present value of those streams of cash flows out into the future, discounted back to the present, is worth over $300. So this is the thing that I think is so mind-boggling, and I don't think a lot of analysts or I think they might just be skeptical about this. But I mean, if I had some investment and I was like, all right, Hans, give me $100, and I'm going to give you a stream of cash flows that's worth, let's say, $340. Like, how much? Like you would put as much money as possible into that type of return, because I mean it's a present value. It's not like I'll give you $300 in 10 years. I'll give you a stream of cash flows that today is worth $340. Like that IRR is insane. And management's actually like provided some calculations on their investor website detailing exactly that IRR, and it's over 100% IRR that they're getting in this customer acquisition spend. This is essentially the what's making the cash flows of the business so strong. It's why I'm coming up with this, $192 share price when the stock's at 72, is because I'm doing the math of, okay, well, if you can actually acquire all these customers at these economics, and you just ramp up that spend over time, what does the present value of all those cash flows look like? And it turns out it's a lot higher than where the stock is today.
So one of the question that I would have on, the future predictions of LTV to CAC, like, is there basically elasticity in the price of customer acquisition as they, reach 10x the number of customers that they're trying to acquire compared to today?
Yeah, so this has actually been one of the questions I've consistently asked management every time I've had a chance to ask the question, because it stands to reason. Well, actually, let me back up a little bit just to give slightly more context before I give the answer. So management strategy, and this is something they reiterated at the last investor day, was not to kind of maintain an average LTV to CAC of let's say 3.2 or 3.4 or something like that. But it's really to spend every quarter until their incremental LTV to CAC is at a little bit over 1. So in other words, it makes sense to spend as many dollars as possible on an LTV to CAC ratio that's higher than 1. That's just kind of like pure, economics that just makes sense.
Easy.
So what they're trying to do is to get that marginal, like that last dollar that they spend of their total marketing spend as close to 1 as possible, with like a modest buffer. And so my skepticism, like a year and a half ago especially, was that as you scale this sales and marketing expense, you wouldn't be able to essentially you wouldn't be able to scale this marketing expense without,
at some point you're going to hit diminishing returns.
Exactly. So you don't want to spend any dollar that's like a 0.9. And so if you're going to be growing aggressively, you would just hit some limits. So I've pretty consistently asked this question to management. And the simple answers I was getting a while ago were, we're actually just finding more and more ways to creatively spend these dollars. And our marketing team is like, no, we don't think we can do anymore. But then they find a way when pressed to get a little bit more creative. That's the kind of somewhat unsatisfying answer that I would say management was giving me for a while. But one of the things that I think is actually a more cogent and realistic answer is, as their loss ratios are coming down, the lifetime value assumptions get way more valuable. So just to give a simple example, let's say that I'm spending money to acquire a customer that has an estimated loss ratio of 80%. Now, the loss ratios that they use for their LTV calculations are generally from their historical levels. Now, they will they'll give some credit for what they think the future is going to look like because they're constantly improving their models. But for example, I asked them about cross-selling for car, because car is a very high dollar value item. So if you're acquiring a renter's customer for, let's say, $400 of premium annually, and then all of a sudden they buy a car insurance policy also, well, that's $1,900. So there's like a multiple more revenue, premium, and then cash flows that you could assume from a renter's or a pet customer that all of a sudden adds a car policy. And so I asked them, I was like, well, what are your assumptions on that LTV for that pet customer today, who historically has had an extremely low conversion rate to car? And by the way, car loss ratios were horrible historically. They were they were over 100% for a long time. Then they were recently like around 90%, and only now are they below 80%. I think it was 78% or something like that last quarter. And so what happens is the LTV assumptions that you had for a customer that you acquired, let's say a quarter ago, didn't assume really any material cash flows from a cross-sell. One, because the conversion rates were very low historically, and two, because the loss ratios on car were really bad historically. So you put those two things together and it's like, all right, well, it's not that helpful. Then as car becomes, let's say 70, 75% loss ratio in the future, and conversion rates go from, or cross sell rates, let's say, go from 5% to maybe 10%. And then when it's available in all 50 states, maybe they go to, 20, 30, 40%. Well, all of a sudden, the LTV assumptions for this, pet insurance customer that you got right now get massively more profitable. And so, you might be acquiring somebody today, for a premium level of $400. But it might be that on average, they cross sell and are worth, $1,100 of premium on a weighted average kind of probability weighted basis in the future. And so when you start adding all those into your model, then all of a sudden the LTV number increases significantly. And so that's what allows you to then spend more to acquire more customers, because you got you can spend a lot more to get that incremental dollar down closer to one when your starting value LTV is so much higher.
Well, and especially as you build out your portfolio, not only to cover more products, but also more geographies. Like, you may cover auto here in this state and that state and that state, but then all your other customers who are in all the other states, you can't necessarily cross-sell to. But then as you expand that, your ability to cross-sell significantly increases. And then the other thing, that relates to customer acquisition, that was, I think, the big pivot point for me, is coming back to, that move, if they're able to make it, to actually selling, to being the low cost provider. Like, if they can beat competitors on price, which is every time I've cross-shopped them, they've never been able to get even really close to the rates that I was paying for home and auto. If they can actually be the winner, then I would think that actually makes the cost of customer acquisition significantly lower. That, it's like, how many people really care when they're shopping for insurance about all of the fancy schmancy doodad things that Lemonade does now versus, did you save me money? Okay, sweet. I'm in.
Yeah, that's exactly right. And I think management is intentionally kind of discriminating right now. So they're trying to really cherry pick only the best customers.
Almost like Tesla intentionally cherry picked their FSD beta testers for many, many years.
That's right. Yeah. Yeah. So I've seen a lot of comments of people being like, oh, you charged me more, or you just weren't competitive. If you go back and watch their last investor day, they say that they're explicitly going to do that. So there's on car insurance, for example, they price it based on how you're actually driving. Like, that's key to their entire scenario. And so the rough numbers are that there's something like 2/3 of drivers are subsidizing the worst 1/3 of drivers. So if you happen to be, the worst in the bottom 1/3 of drivers, at least in terms of probability of an accident and what that means to the insurance company, they're going to charge you a higher rate. And you might start out at a lower rate, and then based on how you're driving, they might increase your rate. And that's going to lead to some unhappy customers. But that's also really core to the strategy, because sure, you're going to piss off this 1/3 of customers over here
who are causing you pain feel the pain in return.
Yeah, exactly. And it's like, okay, if you want to go somewhere else, by all means, go back to Progressive and Allstate and have their customer base subsidize you. And then that's just going to make, Lemonade even more cost competitive over time, as you've got this cycle of they can provide lower rates, at least in theory. I think this is likely to happen, but it's a really important piece of the thesis. If they can price accurately and compete on price for for those 2/3 of customers, then more and more of them will leave the Progressives, the Allstates, the Geicos of the world because of Lemonade's lower rates. And then those incumbent companies are going to be left with an increasing proportion of the bad drivers, which will then kind of make the next tranche of okay drivers even more competitive, because they're still subsidizing this 1/3 that's too bad, or that's driving worse than average. So to me, that whole flywheel idea is very compelling. I think it's going to take a long time for that to really play out, because Lemonade's such a small scale player right now. But it does give me some confidence in the long-term thesis that there's going to be a lot of room for them to grow into the future. Well, since we're on this topic, let's take a pivot away from the income statement right now and kind of get to the customer cohort model that I was talking about, because I think this is highly relevant. So I really have this model, like I said, that I think is quite a bit different. Where I've got this kind of build up down here where I'm saying, all right, what's the customer acquisition cost? How much are we spending on marketing? That's actually an input. And then I've got a set of assumptions for every single cohort. So like what's the loss ratio in each year for this cohort of customers that was acquired in Q4. So you can see, where the loss ratios are kind of coming down over time over here, what the inflation assumptions are, what the churn assumptions are. And then this gets to like a customer count. So I've got all these kind of figures. And then what I do, so then what it turns into though is like a waterfall of customers. So you've got each quarter I'm updating this. So like for Q4, you acquired this cohort of customers, but then when you're in December of 2032, you've got some amount of this premium still left. So the assumption is a good chunk of that's going to kind of churn away over time, based on your ADR assumptions and historic churn rates and everything like that. But then these customer cohorts stack on top of each other. I think it's actually super important to build your model up this way. And I know it's small, but like the point isn't necessarily to see the numbers; it's to see how the benefits and the premiums stack for these cohorts over time. So that was the premium assumption, and then this is like the contribution margin. So essentially the premiums less the payouts over time. So you can see these benefits really start to stack up. And then when you come back to the model, essentially you can kind of look at all these figures and calculate a lifetime value for each one of these cohorts that you've acquired. And then this gets you an implied LTV to CAC, which is an output. So you can see right now, I'm assuming 3.5. They haven't told us exactly what this LTV to CAC is right now, but they've said in the past that it was over 4. And they said most recently that it was over 3. So right now, I'm assuming it's at 3.5, and that it kind of slowly ticks down over time, but does stay above 3. So this is one of the kind of key assumptions is this LTV to CAC, because it has a pretty big impact. So that's how I'm kind of building this up, and I do think it's different from any other model that I've seen in terms of how to look at it. But to me, it seems like that's the right way to do it, because that's how management is making their marketing spend decisions. And then I'm assuming that the CAC increases over time, especially as you're trying to sell more like high dollar value products. So that customer acquisition cost increases as you're going from selling like pet and renters policies to like a $1,900 car policy. Like that's just a more expensive acquisition to get that. All right, so then kind of coming back up here into the model, how does this all translate? So, you've got the increase in marketing spend going forward. And then what happens is you've got this is the way that management reports it, this comprehensive loss. So I've got them kind of crossing the threshold just barely into profitability in Q1 of 2027. It might happen a little bit later than that. It might happen a little bit earlier than that. Kind of depends on some of the assumptions, but regardless of when exactly they hit that inflection point, to me, that like the much more interesting thing is wow, hey, look what happens to net income out here in these out years. So in Q4 of 2028, there's 72 million of net income, which translates to 91 cents of earnings per share. So if you just look at this earnings per share line, I mean, watch what happens, and I'll kind of show you here you've got the trailing and the forward earnings per share. Here, which I find is just like a pretty helpful way to kind of look at this. So as we're going out, further and further, all of a sudden, okay, you're getting quarterly earnings of over $1 now, and trailing earnings per share of $4.41. Yeah. And then like when you get out to 2032 and 2033, all of a sudden you're at like roughly $20 in earnings per share, which is just like crazy, and quarterly earnings per share of like over $5. I mean, these get to really wild numbers. And this is at an in-force premium level of just under 10 billion. So that's the kind of key assumption, thinking of like what kind of scale are we at? And this is very roughly in line with management's long-term guidance of the 30% in-force premium growth. If you just track that forward, they'd be getting to 10 billion in in-force premium by 2033. So this case is roughly in line with the guidance that management gave on Investor Day. So like these sorts of numbers, if they're possible, I think this is that operating leverage that you were speaking about. This is just like a cash flow printing machine. So this is the earnings per share. But the way that I've actually valued this, come up with $192 per share, is actually on a cash flow basis. So I've got a bunch of different assumptions in here. This is like how much of the marketing spend is general catalyst funding, how much is Lemonade funding, how much is Lemonade paying back General Catalyst. So as we get to these out years, I'm assuming that there's no more originations from the synthetic agents program. And by 2033, they've essentially paid General Catalyst back for all that spend. And so when you come down to the cash flow here, it's like over $500 million in quarterly cash flow. So coming up with like a terminal value here of $32 billion in 2034. And so this I find is kind of a helpful way to think about this.
And that's the cumulative addition of all of the positive cash flows from now until that 2033.
No, so yeah, let me back up a little bit. My valuation nerd in me is kind of coming out a little bit. So this is a forecast of the quarterly cash flows. What I have is a net present value calculation. So if I come back over to this side of the spreadsheet, you can see that what this formula is doing is basically just taking the net present value of all these cash flows. That these are cash flows to equity. So importantly, like you've got to take out what you're paying back to General Catalyst, which you see in these back years. So like accounting for how much cash flow like is actually distributable essentially to the equity holders. That's what this calculation is. So because the model, like, I mean, I could build a model that goes out to 2100 or something like that, but that would just be, full of terrible assumptions. So a better kind of shortcut that most people in valuation use is something called the Gordon growth method. And so essentially what you do is you say, okay, in the last year, you generated a little over $2 billion in cash flow. So to create what's called a terminal value, that's okay, what's the value of all the cash flows beyond this point in time? That's the end of the forecast model. So you take the previous year's cash flows, you multiply it by a long-term growth rate, and then you divide it by the cost of equity minus the growth rate. So it's essentially what this is essentially saying is the present value of all future cash flows beyond 2033.
Gotcha.
That's the value of all those, but in 2033. So then you've got to take this value and discount it back to the present. And so one thing that you can do is say, okay, well, what kind of terminal multiple are we assuming here? And so what you can see is this is like a 16 times cash flow multiple, which seems pretty reasonable. And that translates to a 2034 share price of $388 per share. And I looked at a PE multiple. I think that's what I did here. Is that right? Yeah. So I looked at a PE multiple, and essentially what this would be, this price and this share price, it equates to like a PE of 20, which to me seems pretty reasonable. Like not a massive amount of aggression in there. So then, essentially what I'm doing to calculate this $192 share price is taking this entire stream of cash flows and discounting them back to the present, and then dividing that by the fully diluted share price to get $192.
Yeah.
So that's the the kind of big summary, the big shortcut. I've got all sorts of nerdy assumptions buried in here on like working capital assumptions and how all that stuff plays in here. One of the things that I find interesting, have you heard people, especially the bears, talk about the book equity multiple?
Yeah, I'm not a value investor. I just know that anyone who talks about book equity thinks about growth investing much differently than I do.
Yeah, so I agree with you, but I wanted to kind of like think through this and say, all right, well, like if I am a growth investor, or sorry, if I'm a value investor, like what's going to happen? and just I want your viewers to like understand a little bit about what these value investors are thinking, because I think it's just like a helpful understanding. So book equity, essentially what that is, it's like the value of equity on your balance sheet of your company. And so practically what that means is, let's say you raise $1 billion to start your business. I'm going to move you back over here. Yeah. So like that goes onto your balance sheet as equity. It's called additional paid in capital. And then any net income that you have in every subsequent period either, adds to that book equity value, or it subtracts from it if you're running at a loss. And so Lemonade right now is running at a loss. And so what's happening is their book equity is kind of falling down because they're running at a loss. It's just like, all their metrics are improving, but book equity is declining because their GAAP earnings is negative. So all these people who are saying like, oh, like you should be pricing Lemonade on a book equity basis. I was like, if you believe that's true, then the share price, you should expect the share price to decline on a very constant basis up until they get to profitability. And then you should also expect it to increase in proportion, to the increase in book equity of the business. But they just like can't see it that way because they're so used to analyzing companies that have been around for 100 years. And so like the book equity is very stable because, it represents like 100 years of profits, like on the books. Lemonade is like kind of barely squeaking by on their book equity because they're running a very tight ship, but they're about to hit this inflection point where they're literally doing $5 in earnings per share per quarter, like we were, kind of looking at earlier. So what happens if I can share my screen again, when you just think through this exercise? So, all right, right now, like their book equity is only $436 million. And so if you just say, all right, they should be priced at 3 times book equity, which is something I've heard, then the share price today should be like $17 per share. And then it just drops. And then all of a sudden around here, they become profitable. So it starts to increase. But then, what happens as you're like very significantly increasing in your earnings? Well, your book equity essentially doubles in a less than 2-year time frame from right here. Actually, I mean, let's just take this one as an example. It goes from 505 to over 1 billion in less than 2 years. That would imply that the share price should double in less than 2 years, and that's like a crazy thing to assume, especially if you're a value investor. So it's just it's super dumb because like the book equity is going to hit this trough, and then it's just going to accelerate so quickly. And so if you look at a slightly longer time frame and just kind of play these trends forward, you'd be going from 542 million of book equity and implied share price of $20.84 to $171 implied share price by the end of this, which is like an insane. I don't know if this math is still right because I wrote this on an earlier version of the model, but like it assumes an 8x in share price in 5 years. So like you don't want to use a stupid multiple like that on an immature business. But like I literally was talking to investors at Analyst Day that were like, I like their technology, but I just think like the multiple of book is too high. And I'm like, all right, I don't know what to tell you.
Yeah. Well, and one of the things in your model that I'd love to like that jumped out to me as we were looking at it was, I think, looking at the cash flows here between 2026 and 2028, where you see that big massive swing.
I get myself confused in here. All right, cash flows. There we go. Yeah. So the company's cash flow positive right now, but like, modestly.
Or sorry, I said cash flow. I meant profitability, where we went from being negative, let's see, was it? Yeah. So if you reach profitability in March of 27 and in March of 26, you're massively negative, and then, to the tune of negative 36 cents per share, and then you go to positive 48 cents per share over the course of 2 years. Like that's a huge swing. And and the reason that I look at that is because I think it's pretty hard not to expect a massive re-rating in the public markets when you make, a swing that dramatic around profitability in that short of a period of time.
Yeah, and that's really what I've kind of got here. So this just takes the forward earnings per share, sorry, this figure I guess is actually the current quarter earnings per share over the year prior. Actually, that's actually not quite right. Should be that cell. So here we are, finding errors, fixing them live.
Yep.
But the trend is still going to be very much the same. So, but when you do that, it's like, okay, 235% year over year growth, 197, like you're in the triple digit earnings per share growth for a long time. And even after that, you're, in very, meaningfully high levels. So, one of the things that I was, again, like with any share price calculation, you want to kind of come at it from several different areas. So like you want to do a discounted cash flow if you can, but then you also want to look at different multiples to kind of do a gut check on it. And so, one thing I was just looking at here in my messy sheet, so sorry, this is not super user friendly, but I was looking at, okay, you've got 40% year over year growth in earnings in this particular period that we're looking at right here. So if you essentially just apply a 40 multiple to that earnings per share level, then the stock would be worth $335 at this point on a forward-looking basis. And I was like, okay, yeah, that, like, if they truly are growing, if these are the metrics that they're actually posting at that point in time, then I would expect the stock to be doing somewhere in the neighborhood of that kind of price level. So again, that's a future price, whereas the 192 is a present value. So kind of keep that in mind. I mean, this is a price target essentially 5 years from now. So you'd have to kind of discount that back to the present, but it's another kind of way of triangulating and saying, okay, yeah, this is not some kind of crazy fantasy land. The cash flow support it, the earnings level supports it. Even in the outer years, I mean, the book equity multiple, like the dumb rule of thumb, actually gets pretty close to the share price levels that we're calculating here.
Well, and even if you wanted to be conservative, more conservative, and put that at a 30 instead of a 40, you're still upper 200s.
Yeah. 250 there. Yep.
Yeah.
So you're right. I mean, especially with like the further out you go, obviously the more uncertainty there is. So that's where, I probably bank less on, like the assumptions in my model and more like, okay, how good is the technology of the company actually? How good is the management team? And like, can the market support this? And when I just look at Lemonade's size, I mean, they are just like the tiniest little wart on the overall size of the insurance market. So they've got such a long way to go. And I think what management has really proven to me over the course of the last several years, they went from saying a lot of the right things to proving them, that their AI actually can price appropriately. And like, if that's true, putting the modeling away and all the cash flow forecasts, which will inevitably be wrong. Like ultimately, you're betting on technology and you're betting on the management team. And if they actually are better at pricing insurance and administering it, at lower cost than the incumbents, which to me seems like obviously true at this point. And if that's true, that's almost all you need to know, like, because they'll continue to gain share. That's going to be the most important thing in the insurance market is like pricing competitively and keeping your customers happy, and doing so at good margins. To me, like Lemonade passes that test with flying colors.
Yeah, I think that, as you're saying that, one of the reminders for me of what it is that I like about Lemonade, structurally as a company is, we've talked about the similarities with Tesla, but I think in another way, it reminds me a lot of Palantir that, they went and did really, really hard software for government clients, both, in special forces and in clandestine operations. And like, just, how do you make something work in that environment? It's really, really hard. And you've got to solve a lot of problems, and you've got to do it with security and all that stuff. It's like, okay, hey, if they can make this crazy wild bet that everyone thinks is dumb. Like the opportunity there, you're obviously, not going to have a big business if that's all your business is. But then if you can learn how to solve a problem in that context, that then you take your solution set, your solution method, and start applying it to more and more problems, and you're able to, grow that and compound that over time. And eventually you're able to take your learnings from that and say, okay, Mr. Fortune 500 company, like I can massively transform your business in way less time with way better results than anybody else out there could possibly do. And you prove that over the course of several years in corporate. And then, you end up with 70% CAGR on, US commercial business. Then like that's the type of overall strategy that can produce incredible results. That's what we've seen with Palantir, but that's the type of thing that we're seeing here with Lemonade is just this, like solving insurance in the age of artificial intelligence using pure software and not relying on all of the old rules of thumb, but re-underwriting it from first principles is a big, hard, hairy problem that is going to take some time. Like there's so many intricate pieces of what go into actually operating an insurance business. But once you finally get everything tweaked and dialed in and, you have it, it's here we can go back to the Tesla FSD analogy. If you solved 99.9% of the problems in FSD, you still can't scale to robotaxis.
Right.
Right. You've got to do all the problems and all the nines. And, insurance is the same way. Like you can't solve 99.9% of your underwriting problems and, claims and reinsurance and customer acquisition and you've got to solve all of them. But once you've solved all of them, then you just have tremendous scalability that no one else can compete with.
Yeah, and it gets to culture. I mean, I think the Palantir example is a great thing. Like they've obviously created like amazing software, and you could make a case that okay, somebody could probably replicate the software that Palantir has developed. But what they really have is like a team of rock stars that are constantly iterating and like solving problems for their customers. And it's that culture, more than their current product set that really is the long-term value creator. And I think the same thing is 100% true with Lemonade. I'll be honest with you, I was pretty skeptical of their AI for a while because I just hadn't like proven like back in 2022. And I was actually at their investor day in 2022. It was literally like a week or 2 weeks before ChatGPT was released. So like the timing was kind of hilarious. But, like the whole thing was about AI and like how their systems talk to each other and iterate and get better over time. They were saying that like at a time when like AI was not really that cool, and they built the company 10 years ago, like before the Transformer was developed, like before, because they were looking forward to like how future companies would actually operate, and they viewed artificial intelligence as really like the key thing into that. So then as time goes on and like the systems that they built in 17, 18, 19, they're just finding that they need to either like throw them out or like iterate on them with these new tools that are out there. And that's exactly what they're doing. So when ChatGPT came out, they're like, oh, you know what? Instead of having all these people responding to customer emails, we can automate a lot of these as long as we're sure that we're not sacrificing like customer satisfaction. And so then like they started this journey of like using ChatGPTs and literally taking these employees that used to be responding to customer inquiries. Now their job was training LLMs to deterministically respond. So like it would follow all of their rules of like how you need to respond to certain types of customer queries while still having some personality and some flair and like being appropriate. So like, they went from like a kind of low level job to literally training AIs. So like that's the type of employees they have. And they don't stop on that. So like they introduced like a voice agent. And one of the things that I think they've done super well is like, so you can call to like work through a claim on the phone, and Tesla actually introduced this with their insurance product too, where like they'll have an AI voice assistant that will say, all right, here's what you do to like, handle the next steps of your claim, which is like kind of helpful. But Lemonades actually went the step further and said, would you like me to do this thing or change your policy or update your credit card? So like they can actually make the changes with the AI instead of being like a chatbot assistance. So they're like all in and are constantly iterating, constantly improving the business model, trying to do more with less, and while still delivering like exceptional results to their customers. And so like that, like much more than the model and the valuation and all that, because like you're not going to get these types of numbers unless like you truly are delivering on
Superior
the
value
product
proposition.
Yep, exactly.
Yep. Well, this was an awesome conversation. I hope that people appreciate the depth of, the amount of work that it goes into creating a model like that. And like you said, these are predictions about the future, and those are notoriously hard. But yeah, there's a lot of valuable insight that comes out of, thinking through all of those questions, putting the math around all of them. And so I really appreciate you being willing to, open up the kimono, so to speak, and show us all of the assumptions that go into that and give us a little bit of a peek. And yeah, people can take it for what it's worth. Maybe that impacts their view on the company. Not at all. Maybe it has some informative view, but this is all for informational purposes only, not financial advice, all the fun things. But yeah, I really, really appreciate your time with us today, Matt, and just, the opportunity to think through these big and difficult questions that sometimes it's hard to put structure around, how do you create that answer? And this was a great way to do that.
Well, thanks for having me on, Hans. It was a great conversation. And I mean, regardless of whether people, agree or disagree with the valuation or whatever, like I honestly just find some inspiration looking at what Lemonade is doing as a company, because, I think I used to work for GM, I worked for a utility, and like kind of like seeing those old ways of doing things. Like it's so obvious to me that, these department heads and department meetings and like, inter-office memos, like all that stuff, that is not the future of like how businesses are going to be structured. So I just get a lot of inspiration from seeing how Lemonade is doing things. And like, I find it challenging for myself. Like, okay, how can we leverage AI to do more in our company? How can I do it more in my role to make myself better? So regardless of whether or not your viewers think this is a good company to invest in, I'm not going to opine on that. I'd encourage them just to look and say, okay, what are they doing, and how can I try to leverage that in my own job wherever I am? Because I think it's I think companies in 2035 are going to look a lot different from companies in 2025. And to me, Lemonade is a very good prototype of what I think is more likely than not that companies would look like.
Absolutely. Yep. And I was just thinking about Office Space as you were saying that I don't think that they have any TPS reports at Lemonade, and maybe if you have TPS reports in your company, you should think about how to eliminate them.
100%. I need to rewatch that movie, PC Load Letter.
Oh yeah. All right. Well, it was great chatting with you today. I think for our viewers, we will see you in future episodes. We hope you have a great afternoon, and have fun. All right.